Okay, so we know that the Bank of England is in charge of interest rates. So what is an interest rate? So what we know is that so an interest rate is the cost of borrowing money. So when the bank pays, when you put your money into the bank pays you interest because it's borrowing your money. That's your savings rate. When you borrow money from the bank, then you have to pay interest, and it's expressed as a percentage, and it shows how much you have to, how much extra you have to pay back, on top of the amount that you've borrowed, usually expressed as an annual rate. So the rate that you're going to pay, a lot of that depends on how long you want the money for and what sort of risk is involved. So the riskier you are, the more you're going to have to pay. So what you'll tend to see is that there's a hierarchy of interest rates. So if you want to borrow money for a house, a mortgage, then as things stand, you can get we're looking at probably 1 to 3%. So every £100, every £100 that you borrow, you're going to pay back an extra 1 to 3% a year. If you want to take out something like like a car loan or something like that, then you're looking a bit higher, probably sort of 5 to 7%. It depends. And the reason is that whereas a house is very good security, if you don't pay your loan back on the house, they take your house and they sell it. If you don't pay your loan back on the car, it's like, well, they can sell it, but assuming that they may not get the money back and so on and so forth. Following on from that, you've got things like overdrafts. An overdraft is basically where you borrow the bank's money. It's a facility to borrow the bank's money without asking them generally. So you create, it's like an ability to go to minus £500 or minus £1,000. And that tends to be quite expensive. If it's authorised, somewhere around 15%, something along those lines. You could use a credit card, where you borrow the bank's money. Where you buy things using the bank's money and then pay them back at the end of the month or every 2 months, or you can leave that balance to roll. You don't have to pay it back, but then you're often paying sort of 20 to 30% interest on that. And beyond that, there are payday loans, where you borrow very, very short term. You've got some sort of cash emergency. These are people like Quick Quid and places like that. And often your interest rates can reach thousands of percent. Because those are inherently very risky. There's a good chance they're not going to get their money back, and you're desperate. So when we say the interest rate, what we're really saying is there's a hierarchy of interest rates that tend to move up and down together. And the reason for that is that the bank rate, which is the Bank of England's rate, is the rate at which it makes money available to commercial banks. It's called the overnight rate, and they can borrow at roughly that rate, usually plus 1% and so on. But when that rate changes, that influences influences the extent to which banks can easily and cheaply get cash, and therefore it has a knock-on effect throughout the system. So when the Bank of England changes its interest rate, other interest rates will tend to move, but they don't have to. So let's imagine that what happens is that the central bank decides, like it just has recently, it's cut interest rates from 0.75%. That's where they were, before the coronavirus crisis. The Bank of England has now cut them to 0.1%. So in theory, what the Bank of England is hoping to achieve, is it's hoping to increase demand. Now, ostensibly, that's because it's kind of saying, oh no, inflation will fall. But obviously we know that at the moment, what they're worried about is, the world ending fundamentally. That the level of economic damage that it's going to do, that coronavirus is going to do, is going to push the economy into a huge recession. And then inflation would fall, but that's not really what the Bank of England is worrying about at the moment. So what they're expecting is that that's going to affect three elements of aggregate demand. Firstly, they're expecting that it's likely, a decrease in interest rates is likely to increase consumption. And that's going to happen for 2 or 3 reasons. The biggest reason, is via what's called the mortgage rate effect. So mortgage repayments. So in the UK, a lot of people, because house prices are so high, you can only buy a house if you take out a loan. Some people have tracker mortgages and also variable rate mortgages. And what that means is that when the Bank of England's base rate changes, the interest rate on your mortgage changes. A tracker mortgage, it changes straight away. An adjustable rate or a variable rate mortgage, it'll tend to follow in a few months' time. But what that means is that you're automatically paying less back to the bank on your mortgage therefore you have more money available to spend. Secondly, it makes borrowing cheaper. Yeah, so borrowing on credit cards and so on and so forth, personal loans, they tend to be a lot cheaper than they used to be. And therefore, people in theory have an incentive to go and buy a new car or to buy other things on credit. These tend to be consumer durables, cars and refrigerators, kind of big American style, fridge freezers, sofas, that type of stuff. Those are the sorts of things you might take out a loan to buy. And thirdly, less importantly, it's likely to lead to a decrease in savings in theory. Although you want to be quite careful with that one. I mean, the impact of low interest rates on me is because I want to retire, I'm actually saving more, because my money is doing less work for me. And then linked to all of that, what we'd expect to see, is because borrowing's cheaper and it's easier to get a loan, people are more likely to buy assets like houses. So we also are likely to see an increase in asset prices as well. And when asset prices increase, our wealth increases. So because we're wealthier, we've got more ability to take out further loans, and of course you feel more confident. So therefore, we would expect consumption to rise. Secondly, we would also expect investment to rise, investment by firms. Firms are more likely to invest in new capital stock for two reasons. Firstly, obviously, borrowing for firms is cheaper. And secondly, rising consumption means that there is more reason to invest. You're more likely to make a profit, or if you're, say, a supermarket or something, you think about opening kind of new stores. Well, if consumption's rising, it makes sense, to open more stores. So your confidence is going to be higher, your expectation of profit is going to be higher. So it's cheaper to borrow, and there's more reason to invest. And thirdly, and this is something that we'll come on to a bit later, it's likely that when interest rates go down, it is likely that that's going to cause the exchange rate to go down as well. The exchange rate, other things being equal, is likely to depreciate. And the reason for that is that what you remember is out there, there are investment banks and speculators that have literally trillions of dollars. And what these people want to do is to keep that money. They want to keep those trillions of dollars where the rate of return is highest, where they can get the most interest. Because even a tiny difference in interest rates, makes a huge difference if you're talking about hundreds of billions of pounds, even for a relatively short space, even for a few days. There are accounts where there are savings vehicles where you can get money paid on a daily basis, and if you're shifting billions, then you want the highest rate that you can. So if interest rates in the UK were to go down, and interest rates everywhere else stayed the same, then what's likely to happen is these speculators, the ones that have been holding their money in sterling, holding it in pounds, holding it in London, they're going to say, well, screw this, I want to put this money somewhere else. I'm going to take it and I'm going to put it into the States. I'm going to put it into Japan. I'm going to put it into the Eurozone. But in order to do that, they then need dollars or yen or euros. So they will, so what's going to happen is that because interest rates go down, they sell pounds. They sell pounds on foreign exchange markets, and they use those pounds to buy dollars. As a result of which, the pound weakens. So instead of being, say, £1 equals $1.50, we drop to, say, £1 equals $1.20. And that in itself also has a couple of effects. What it means is that from an American perspective, if you wanted to come and do a course at LSE, the price of exports, PX, goes down. LSE costs the same amount of pounds. It costs, say, £20,000, £30,000 a year. But the number of dollars you're going to need to buy that is less. So suppose LSE costs $50,000. Pounds. Suppose LSE costs £50,000, including accommodation per year. There you would need $75,000. Whereas here you'd only need $60,000. So the price of exports is lower. Therefore, exports are going to go up. But secondly, from your point of view, try and buy something from the States now costs a lot more. You want to go to Disney, suppose you want to buy a day pass for $150. There it costs you £100. There to get $150, it's going to cost you more than £100. I don't know, £120 or something. So the price. So the second thing that happens, apart from the price of exports going down, the second thing that happens is the price of imports goes up. And therefore, people are more likely to stay at home. They're more likely to buy British goods. So therefore, what we're saying is that a decrease in interest rates is likely to lead to an increase in aggregate demand. It's going to lead to an increase in consumption, an increase in investment. It's going to lead to a decrease in the exchange rate, which is going to lead to an increase in exports and a decrease in imports. All of those increase aggregate demand and are therefore likely to lead to an increase in inflation. And there's also a direct effect on inflation. Because the price of imports has gone up, the price of everything that we buy from abroad, the price of rice, the price of pasta, the price of star fruit and so on, the price of imports goes up. Therefore, we get both what's called cost push inflation on the one hand and demand pull inflation on the other. So cutting interest rates increases aggregate demand. It also drives up the cost of importers. Therefore, that contributes to inflation. So, on the other hand, those effects aren't guaranteed. So a decrease in interest rates. Why might it not affect aggregate demand? Well, often when we cut interest rates, confidence is quite low. At the moment, we have what's called the zero bound problem. In other words, you can't really have negative interest rates. So at the moment, the Bank of England is now a bit stuck. Because it's cut interest rates to 0.1%, it can't really have negative interest rates. In other words, you can't pay people to borrow money. You're gonna be bust pretty fast if you do that. During the financial crisis, banks actually, bank confidence was low. So that's consumer confidence. Bank confidence was low. They'd lost a lot of money. They didn't want to lend. So even though interest rates were low, banks weren't lending. And also, it's kind of there is a risk that commercial rates don't follow. So in other words, the central bank can cut its interest rates, but apart from tracker mortgages, there may be a big delay before it passes on interest rate cuts, to other people. And as a result of all of that, and also it just takes time for people to respond. So the impact, there are likely to be significant time lags, in all this as well. So people, interest rates don't fall, and people don't immediately kind of run out the next day and go, "Ooh, I'll buy a car." It takes time for people to notice. It takes time for people to respond, and so on. So there are a significant number of issues, that mean that in principle, a cut in interest rates should increase aggregate demand, but there's no guarantee that it's necessarily going to do so.